Thanks for joining us for Financial Planning Basics today. My name is Tim Slevin-Vegdahl. I'm a certified financial planner. I do educational seminars like this, as well as meet with people individually for their financial planning needs. I work for a company called Multnomah Group, which basically works on your retirement plan with the investment committee to help design the plan and choose investment options. This is the first webinar in our series for Q2. So we will still have 5 others on these various other topics as well. So feel free to register for those if you'd like to. And if you can't find the link, feel free to email me as well. What we'll be talking about today is setting goals, budgeting, credit and debt, some basics about taxes, some basics about investing, and then talking about saving and planning for some longer term goals that most people have, like saving for college, as well as retirement planning. And then finally, we'll wrap up with a few things about estate planning. We do have the Q&A open if you want to ask questions during the presentation. General questions that would apply to lots of people's situation is great, and feel free to put those in the Q&A as we go through. The first thing we'd like to do is talk about setting goals and why goals are important. You can have many different types of goals in life, such as paying off credit card debt, buying a car, buying a home, funding school, or even retirement. And these goals are going to be different and really inform how we're going to approach saving and maybe even investing for those goals. We care about things like time horizon, as well as how stable the money needs to be, and what kind of time frame you have for those goals. We like goals to be specific so that we know as we're achieving them where we are along that path, and on that note, measurable as well. Specifics about when and what exactly we're trying to achieve financially are very helpful for us being able to do analysis or make choices towards achieving those goals. We like goals to be attainable. Generally speaking, if you're changing assumptions like increasing the rate of return that you get, that may be an indication that your goal isn't very attainable and you may need to think about changing the goal. We want it to be relevant to you and your circumstances and values, meaning that it's just, in alignment with the way that you want to spend money, and then timely as well. So let's look at a couple examples of this. But do remember, actually going through the process, writing things down, putting it in a spreadsheet, doing something related to it really is more likely to make you accomplish your goals, as well as it's an important measurement technique against those goals. Some examples of good goals are, I'll pay off $10,000 of student loans in the next 24 months. We can see that what it is, how much it is, and when it will be done by is all accounted for as part of that goal. So we can hold ourselves accountable or make trade-offs with that goal. Another example of a goal might be something like, I'll get my retirement account to $100,000 by the end of 2030. When we're talking about goals like retirement or very long-term goals, we almost always want to break them down into smaller goals. So the goal that this might have resulted from might be, I want to retire in, 2050. But then we set a benchmark and we can break it down further into, I want to increase my savings rate to at least 12% by the end of this year. As we think about budgeting, we are trying to get an idea for how our income and expenses interact with each other and what that says about what we can achieve in terms of financial goals. So we want to start by understanding what our income is, both from paychecks, any side hustle or gig income we have, government benefits such as Social Security or possibly disability, as well as maybe pension benefits, and then interest and investment income that we have from stocks, bonds, real estate, anything like that are all part of our income picture. For expenses, we have two large classifications of expenses that we think of. One is fixed expenses. These are going to be things that are pretty much the same month to month or year to year and cover needs like housing, food, transportation, health, things like that. Discretionary expenses are more wants. This would be like dining out or entertainment or that new car that really isn't a need because you have a perfectly working car in the first place. That would be another example of a discretionary expense. As we categorize these things, we can figure out do we have more income than expenses and thus we have a surplus of money that we could put towards another goal? Or is there a deficit and we might need to reduce spending just to be in alignment? And often both of these are part of the budgeting process. It is helpful for a lot of people to start by using a budgeting tool. One of the things as we're looking at understanding our income and expenses, especially the expense side, is most people just don't know. So if that's you, you're totally not alone. But it's helpful to link up your accounts that you spend from to any of these budgeting tools. Some common ones are You Need a Budget, Every Dollar, Monarch Money, and I think I've also heard Rocket Money recently. Some people are liking. I haven't used it myself, but this is helpful because it will get you data that you can go through and classify based on your history and get to understand things much faster. But if you really like to do things by hand or kind of do it yourself and that engages you, you're definitely welcome to build your own tracking system with like pen and paper or an Excel spreadsheet or something like that and do the tracking yourself. Thinking about where we have control over our spending habits, these will be, kind of discretionary expenses again, online shopping, subscriptions, leisure and entertainment activities, as well as just thinking about what other discretionary things you have. Generally, if you're trying to cut in the short term, you want to focus on sort of discretionary non-fixed expenses. It's really hard to decrease your rent or utility bills or transportation costs in the short term. However, if you have a very large deficit, it may be necessary to make some changes to like where you live or things like that in the long term. All good financial plans have an emergency fund as part of them. It's a foundation for successful financial plans. The purpose of an emergency fund is so that when you have unexpected expenses, you're not borrowing on high interest debt and kind of derailing your financial life. That gives you a buffer. So we want emergency funds to be liquid and easily accessible. The point of this money is not to grow, it's to be there for short-term needs when we need it. So we like this to be located in some kind of bank account, checking, savings account, money market account, something that you can easily access it. And we generally want between 3 to 6 months worth of expenses, depending on like how variable your income is, how much you would be able to cut your expenses if you needed to, and if you have multiple incomes in the household. And just start small. Start with something that you feel like you could save in a month, maybe like $1,000, and then build that up over time to what you'd like it to be. Now I'd like to talk a little bit about using credit. Credit is borrowing money now to obtain something before you've paid for it, based on the understanding that you will pay for that in the future with future earnings. The 3 C's of credit, which tell lenders kind of how credit worthy you are, is capacity, your ability to pay back, the character, especially of your income and how stable that is, and then any kind of collateral that they can have. This is very common with like car or home loans, where they actually have a lien against the item you're buying with that loan, and they could repossess it. That will tend to make them more likely to loan you money. There's some different ways that creditors determine creditworthiness. One is through the information you provide about yourself on a credit application. They will often pull your credit report to see if there's anything concerning there. And then finally, they use sort of this all-in-one number. Well, I guess there's a couple different agencies that provide them, but your credit score is supposed to be one number that provides them an idea of your overall credit worthiness. If you're curious to see what your credit score is, you can go to annualcreditreport.com for a free one annually. As you're thinking about debt, we also want to think about what type of debt we're taking on. Just to jump ahead slightly, we do think about some debts as like good debts or bad debts, and these can be indicators of what kind of debt that you have. So secured debts for a mortgage or car or tangible items tend to come with lower interest rates, which if they are for necessities makes them, better that you're paying less for that. Unsecured debts tend to have very high interest rates associated with them. This would be like credit cards and personal loans. So important considerations for debt are the amount that you need to borrow, the length of time that you need to borrow it for, and then these combined with your other credit factors will kind of determine what rate you get charged. For good debts, we generally are okay with using money to buy appreciating assets, but you do have to be careful even with real estate and such. You do want to make sure that you have plenty of margin and don't become house poor, but we especially want to be concerned about using larger amounts of money than we need to buy depreciating assets like cars. Those can really hurt us quite a bit more in the long term. As you're looking to pay off debt, there's 2 kind of common methods that are used. One is the debt snowball and the other is the debt avalanche. So for each of these, you would organize all your debts. With the snowball, you would start paying them off with the lowest balance first. With the avalanche, you would pay it off starting at the highest interest rate first and then work your way down. And there isn't really one of these that's better, because when it comes down to it, finance isn't just about numbers. It's about what works for you psychologically as well. And if you're working through a lot of debts, my understanding is that the snowball method can really help you build momentum and get some debts paid off quickly. And that can be very psychologically helpful for following through on getting out of debt. Whereas if you were to dedicate a certain amount of money, the avalanche would be mathematically optimal. Are there any questions about budgeting, cash flow, and debt? Feel free to put them in the Q&A. All right, I'll check in again at the next section as well, but feel free to put them in the Q&A anytime. So now we're going to go over kind of the basics of taxes. First, let's start with common types of taxes. You may be subject to any number of these. One is income taxes at the federal and state level. These can also be at the local level with a city or municipality as well. For example, where I live in Portland, there are local level taxes on people above a certain amount of income that are income based. Generally speaking, these taxes are marginal tax rates. They certainly are at the federal level. This means that the more taxes that you pay, those top dollars will be paid at a higher marginal rate. So for example, if you are a married person and taking the standard deduction, you would, let's see here, in 2026, you'd get to take $32,200 completely tax-free with that deduction. And then your next $24,000 about would be at the 10% marginal rate. And then if you make more than that, you'd be taxed at the 12% rate. And if you make more than that bracket, at the 22% rate. So that's a marginal tax rate. We also have kind of flat taxes, such as payroll taxes, where you pay on the first certain amount of your wages, at least, you pay a flat rate, a 7.65% of your wages, and then the employer also puts in matching 7.65%. There's also sales taxes, a lot of places, which is where the cost is just embedded in goods that you buy. Property taxes, if you own property. I'm not aware of anywhere that doesn't have property taxes of some kind. These are usually used by the local level of government. And then finally, there is another kind of special kind of income tax called capital gains, at least at the federal level. This is usually split into qualified long-term capital gains and qualified dividends that have preferential rates. And then other things are taxed at ordinary income tax rates. And this is only applicable to non-retirement investment type accounts. As we're going through this, remember that I'm not a tax professional. That would be a certified public accountant or CPA. So if you have very specific tax questions about your situation, please do consult the proper professional. As we're thinking about income tax strategies, taxes are not avoidable for the vast majority of people, but they can be managed and understood and planned for. So we want to talk about 3 different kinds of ways that you can affect your taxes potentially. There is adjustments, which is also known as an above the line deduction. These are things that come out before you get to the AGI part of your tax return and reduce your taxable income. They'll also tend to help you qualify for other things, as your AGI is generally something that's used to figure out what you qualify for in terms of other types of deductions and credits. And then we have below the line deductions. This would be like the standard deduction, or there's actually a bunch of non-itemized below the line deductions as well as itemized deductions. So for the non-itemized ones, there's one for seniors 65 and up. There's also a small one for charitable contributions, overtime, tips, car loan interest. Those all are kind of more recent ones. And then we have, if you itemize, then there will be, mortgage interest, as well as charity and various other deductions kind of below the line. For credits, these are reducing what you owe on taxes below the line. Credits are better than deductions if you can get the same amount of credit as that deduction, because a credit would reduce the amount you owe by $300 if it was a $300 credit, whereas a $300 deduction would only save you paying taxes on $300 at your highest marginal tax rate, which will never be 100%. So using these all together, let's look at how the taxes are calculated. We take the total income, gross income that you've earned in a year. We minus off the adjustments or above the line deductions. This gives us our adjusted gross income. And then here is the line. What we come up with here will be usually what we use for deciding which taxes or which deductions and credits below the line we qualify for. And then we take our adjusted gross income, subtract off the below the line deductions. This gives us our taxable income, the amount of income that we have to pay taxes on. We multiply that through the tax brackets to get the amount of taxes that we owe. And then what otherwise would be tax liability, we subtract off the credits, and this gives us the total amount of tax due. And generally, you won't have to pay all of that at the end of the year because your employer or you, if you're a small business owner, have been withholding throughout the year so that you only have to pay the difference or get a refund based on where the taxes actually come out. So just going through quickly some various examples of these deductions. One of the largest ones that reduces above the line are pre-tax retirement contributions to 401k, 403b, and contributions to like health savings account or flexible spending accounts. Also, if you're using money to pay for healthcare premiums, that all comes out pre-AGI as well. For below the line deductions, generally we're looking at the standard deduction as the largest one. And I mentioned there were some other non-itemized below the line deductions, but for itemized, if you're taking that instead of the standard deduction, you would be able to add up mortgage interest, charitable deductions, state and local taxes up to $40,000, unreimbursed healthcare costs, and take that instead of the standard deduction if that's more beneficial for you. Common tax credits are a child tax credit, dependent care, lifetime learning, earned income tax credit. The state of Oregon has a state kicker as well. And then 529 deductions depending on the state that you live in. Most credits do have, like I said, either adjusted gross income limits or modified adjusted gross income limits, which is why those above the line deductions can be very helpful because it can help you qualify for those. Some things to consider with income taxes. It's very beneficial to get deductions from your paycheck before taxes are calculated. This can lower overall out-of-pocket costs. Some examples of this are if you can get money taken out for healthcare or dependent care, there's types of accounts and programs for this, as well as transportation costs. And of course, retirement plan contributions if you're doing them pre-tax as well. This results in tax deferred growth. You don't have to pay taxes on the money until these funds are withdrawn from the account. Some examples of this are retirement plans, health savings accounts, and college savings plans with 529s. In addition to the deferral, the 529 and HSA options, if you're using things for qualified types of expenses, you won't have to pay taxes when the money comes out either. But do note that for all of these types of accounts, they are meant for specific purposes. So you get this tax benefit in exchange for flexibility. And if you do not use them in the intended way, you will have to pay penalties and taxes potentially on taking the money out. So I'll stop here for a little bit, see if there are any questions about taxes. All right, then we'll move along to fundamentals of investing. So one of the things we want to consider is why we want to invest. And one of the reasons for this, and it's related to time horizon, if you're trying to fund expenses that are very far in the future and you just put money in a bank account that has a low yield or under the mattress, I guess is the stereotypical example, that's not very effective if you're trying to fund an expense that's 20, 30 years in the future. The cost of whatever you're trying to buy is likely going to be a lot higher in the future. As we can see in 2020 versus 2040, we're looking at almost a doubling of the cost of things, assuming a 3% annual inflation rate. And that is, going to make it extremely hard to fund those long future expenses if we're not getting some kind of a rate of return. So I'd say the three most fundamental things in investing that everyone kind of needs to know is time is your friend. Compound interest is a crazy awesome thing. So if you start early, it can do great things for you. And it becomes very hard if you wait too long. So start now and let the compound growth work for you. Another thing, which is known as the only free lunch in investing, is diversification. Don't own just one investment or one type of investment or one geography of investment. Create a portfolio that is well diversified. And then finally, try and keep costs low. There's definitely things you have to pay for in investing, but ultimately you kind of get to keep the money that you don't spend on expenses in investing. So when you're not getting value, keep costs low. Key variables in thinking about how to invest are time horizon. When do I need the money? When is this expense going to happen? Risk tolerance, which we'll talk more about in a future slide, but this is sort of the psychological effect that losing assets can have on someone. If you're in risky assets, you have to have a tolerance for that because the worst thing you can do is pull out of a portfolio when things are down. And then finally, what asset classes you have and are comfortable with. The longer your time horizon for the goal, the more risk that you can take. So that's sort of the risk return trade-off. The more risk that you're taking in the short term of assets going up and down, you're generally rewarded with an expectation of higher returns in the future. You also want to think about your personal tolerance for risk. This is what I was mentioning before. Will you be able to sleep at night if your portfolio is down, 10, 20, 30, 40% from the beginning of the year? These things are all possible in a high risk portfolio. And you need to be able to ride out those things in addition to scary things happening in the world often that correspond to them to get rewarded with the higher returns. And then finally, there is risk capacity, which is the ability of your plan to deal with potential losses. If you're going to be, this is one of the reasons that if time horizon is short, we want things in a very stable place. You don't want to be counting on money at a specific soon point in time and finding that it isn't there because it was in a risky portfolio. Typically, we think about three main asset classes in investing. There are plenty of alternatives, but the kind of common ones are stocks, which are on the highest risk, highest potential reward side of the spectrum, with bonds kind of in the middle. Depending on the type of bond, those can be, closer to stocks or closer to cash. And then cash is sort of our lowest risk but lowest potential reward. You can really only earn on cash, what you can get from a high yield savings account. With all these things taken into account, I'd like to introduce target date funds. This is something that you should have access to in your portfolio, in your retirement plan, because these are funds made specifically for retirement. We really like these because they are starting you out and kind of doing a lot of the things that are hard about investing for you. They start out at a young age in a pretty high risk portfolio, assuming that these assets are for retirement. And as you age, they automatically become more and more conservative, becoming more and more bond heavy and less stock heavy. So for example, in a Vanguard fund where you were planning to retire in 2070 today, you might have about 90% in stocks, whereas if you were in a fund that had assumed you just retired, you would be more about 50% stocks, 50% bonds. We like these because they are full portfolios, not just funds. They're well diversified. You have stocks and bonds from all over the globe, different companies, different sectors, different geographies. They align with your retirement time horizon. They automatically rebalance and adjust over time. They're really a good set it and forget it option, which allows you to focus on the things that you need to focus on, which is just when do I need the money and how much can I save? And they really do kind of everything else for you if you set up automatic investments into them, which your employer plan helps you to do. Are there any questions about investing? All right, we'll move along to saving for college and retirement planning. We kind of want to talk about these specifically because these are some of the much longer term goals that we have in general. So for college saving, there is a specific type of account called a 529. These are individual accounts that generally have a pre-established portfolio or set of portfolios that you can choose between. You're kind of bearing the investment risk and deciding to contribute money. These funds can be used towards a lot of different educational expenses. They're pretty flexible now, as well as if you have money left over, even rolling some money into Roth IRAs for your kids as they earn income. But generally speaking, these are money that you're saving to fund either K through 12 tuition for private schools or some kind of college program for your kids, and using those pre-established portfolios to achieve those goals. There also is prepaid tuition plans where you can pay a specific university tuition at today's rates and kind of guarantee that your kid can have an education because it's already been paid for at today's rates. These are generally limited to in-state colleges for for wherever you live when you're making the contributions. 529s offer tax-deferred growth, and all of the earnings and what you pull out is entirely tax-free, assuming you use it for educational expenses. You can also, as I mentioned, contribute to a child's Roth IRA up to $35,000 over their lifetime. So this would be up to the annual limit per year. They still have to be earning income, but if you have a little bit left over and you'd like it to go to the child, that's a pretty reasonable option. Fees and expenses vary with each plan. The plans are run by the states, actually, and so if you don't like the investment options you have in the state you live in, you can always look at another state. Some of them are a little bit more flexible in terms of the investment options, but some states have a tax benefit to investing in the 529 for your state, and that you will only get if you live in that state and invest in your own state's plan. So thinking about retirement, again, especially for these huge long-term goals, do get started on them as soon as possible. The sooner you start, the longer your investments can grow, and it's very hard to catch up later if you wait until a pretty late age. So in this example here, we have beginning at age 20 and saving $3,000 at 6% annually would result in a portfolio at age 65 of about $680,000. If you waited until age 35, you would end up with $254,000. And beginning at age 45, you'd only end up with $120,000. And this is kind of making the same $3,000 annual payment at 6% annually. So this would be $250 a month. Some basic considerations about retirement that you should think of are, what kind of retirement do you want? Some people have pretty simple wants in retirement and just want to spend time locally with family. Some people want to pursue expensive hobbies and travel, and maybe don't even know where they want to live, so they might need to have money set aside for the more expensive locations they might decide to live. You might also want to provide assistance for other family members or charity, or all of those things. Kind of what lifestyle you want helps to determine how expensive retirement will be. Also, when do you want to retire? The earlier you retire, the more time you have to fund expenses for. So you're going to need more dollars to last that longer time period. Social Security isn't available until 62, and generally speaking, you want to delay Social Security as much as possible, even up to age 70. And if you are trying to retire before 65, when you're eligible for Medicare, then that can be some of the most expensive medical years of your life, with the exception of possibly long-term care at the end of life. And then finally, how long will retirement last? Unfortunately, we don't know this ahead of time. Average life expectancy may continue to increase, and retirement can be kind of a long time. I think the best gauge for this is sort of what is the longest living family member that you have in recent history, and that can kind of give you an idea of what your upper bound might be. Thinking about tax advantage retirement savings vehicles, we really like 401k and 403b plans. They provide great tax advantages to us, as well as, generally speaking, employers are making some sort of contribution for you. So please make sure to understand what the match or other contributions your employer makes to make sure you're not missing out on free money. And considering Roth versus pre-tax savings, pre-tax contributions mean you get a tax deduction now. And that may allow you to put more kind of nominal dollars in the account, and then you pay the taxes when you pull the money out. at tax rates at that time. Roth is you pay taxes now, so there's no deduction up front. But when you pull money out of the account, it's entirely tax-free if it is in retirement post 59.5. Generally speaking, which one of these you should contribute to depends on several things. I'd say to give you a heuristic, make sure that you're getting the employer match. If you need to do pre-tax to do that, then go ahead. And then if you think you're in lower earning years, it might make sense to contribute to Roth, and in higher earning years, it might make sense to contribute to pre-tax. You can also contribute separately to traditional or Roth IRAs if you qualify. There is separate limits on those, so you can potentially max out both an employer plan as well as a Roth IRA. But just do remember, money you're putting into these accounts generally is inaccessible to you until 59.5 without some pretty bad penalties. So make sure that you are saving it for retirement. In 2026, you can defer up to $24,500. Everyone can. If you're 50 and older, then you also get to make an additional $8,000 catch-up contribution. Many plans allow this super catch-up contribution if you're age 60 to 63 of $11,250 instead of that $8,000 catch-up contribution. For IRA contributions, generally if you have an employer plan, you won't qualify for traditional IRA contributions. That's the pre-tax ones. But for Roth, the limits are still reasonably high. So if you're single, you can still contribute you can still contribute fully if you make up to $153,000 in 2026. And if you're married, then you jointly can make $242,000 as an AGI and still make the full contribution. There still is a little bit of room above that. If you make slightly above that, you could make a partial contribution. If you're unsure, feel free to talk to your tax professional, which would be a CPA. Contribution limits for IRAs are $7,500 in 2026. As well as you can add an extra $1,100 going up to $8,600 if you're 50 or older. These are separate accounts from your workplace, which does mean that they have those separate limits, which can be very advantageous. But also note that your employer plan is generally a good place in the sense that they are curated, appropriate investment options for saving for retirement. When you open an IRA, you're kind of on your own to invest things. There are target date funds at all the major institutions like Vanguard, Fidelity, Charles Schwab that you can still invest in. But ultimately, instead of kind of it automatically going into those funds, you have to set it up and do the investing. What questions about retirement planning do we have? Or education planning? All right, I'll go ahead and move on then and talk a little bit about estate planning and get through the kind of fundamentals of estate planning. So why do we need an estate plan? I actually really like the framing of this question that is, you actually already have an estate plan. It's just the one that the state you live in has chosen for you. And this gets to intestacy, which is what happens when you go through the probate process to distribute your assets and you have not made it known in a legal way what you would like to happen with your assets. So this already has been defined for you if you haven't defined it. And I think it's worth telling people what you want to happen to your assets. So one of the ways we do this is through wills. This is kind of the catch-all type solution where we say what assets we would like to go where, how things are split, and then also who we'd like to take care of our kids in the event of our death before they're, of an age where they can take care of themselves. Trusts are tools that allow us to put assets inside them and kind of define how those will be distributed after the fact, whereas wills just kind of affect everything that it hasn't otherwise been decided. We also want to consider planning for incapacity and making it clear what we would like to happen to us medically. We want to make sure our beneficiaries are up to date on accounts because those can often bypass the probate process where your will would be deciding what happened to your assets. We're not attorneys, similar to how we're not CPAs. So if you have very specific questions about your situation, talk to the proper professional, which would be an estate planning attorney. We're just kind of giving a basic overview here. So again, intestacy is not having made a will before you die, and then the state decides how things are divided. If the reason you haven't done an estate plan is because you're having trouble deciding how you would like things to be split up, I don't know how your family is supposed to figure that out, and not having an estate plan can really be bad for family dynamics after you're gone as well. As well as the probate process can be extremely expensive if anything is contested. So a will is kind of the cornerstone of an estate plan. Like I said, it kind of catches everything that you haven't defined otherwise where it would go and directs how that would be distributed. It also names someone for who will do the distribution process as your executor and what you'd like to happen to your minor children. It must be written, signed by you, and witnessed. So you'll want to make sure, and if you're working with an attorney, they will have this on hand, but you'll want to make sure everything's notarized and properly signed and witnessed. So trusts are, I think, actually a great and underutilized tool. They're not actually that expensive if you're talking about a revocable living trust. Generally, a trust is a structure that owns some type of asset and someone decides to put this asset into this trust. That would be the grantor. And then a trustee holds the ability to manage and kind of distribute those assets as needed based on the purpose that the trust was designed for. I think the type of trust that most people should consider is a revocable living trust where the grantors, who again are the people who put something in the trust, the trustees, who are the people managing the trust, and the beneficiaries who are getting something from the trust, are all the same party. And basically, the way that this works is that you can put your assets inside a trust that you still own and have control over, but then if something were to happen to you, it's already defined where those assets will go and how they'll be distributed. And then they don't have to go through the probate process, which can be very lengthy and especially expensive with real estate because it often has to sit there until the probate process is resolved. And this is one of the great things about trusts is they avoid probate. They can also ensure privacy if that is an issue you are worried about. because the probate process is in fact public record. Generally, trusts are a little bit more expensive, but you can generally get a will and a revocable living trust done at the same time by an attorney. And so I think it's still, if you own any significant amount of assets, especially real estate, I think it's worth doing. A little bit less common are irrevocable trusts, where someone will put something into a trust that they lose control of. That's the irrevocable part. These typically can't be updated once created, and then we'll have an executor who is not the person who granted the money into the trust, and it creates a separate tax entity, which can be another complication, as trusts are generally taxed at pretty unfavorable rates compared to individuals. Finally, let's talk a little bit about incapacity. Doesn't matter what your age or situation is, incapacity can happen at any time, and failing to plan means that a family member or friend will be appointed as a guardian or conservator and make medical decisions for you. And that is a huge burden to put on someone without guidance as to what your wishes are. So this is a good reason to plan for it, to write it down. The document that people generally would do this on is an advance directive or medical directive, and this can give guidance to your guardian as to what you would or wouldn't want to happen, which makes it a lot more likely you'll get what you want, as well as decreases the burden of having to deal with that without guidance on someone else. One of the easiest things to do right now, since you probably have a retirement plan, if you're able to view this, is update your beneficiaries on accounts. A lot of types of accounts, this would be retirement accounts, brokerage accounts, bank accounts, as well as insurance policies, have the ability to list beneficiaries on them. These are usually super easy to update and will take precedence over anything that's in your will. So this can be a good or bad thing, but generally speaking, it's super easy to update them and make sure your wishes are met. The reason I say it could be a bad thing is you do need to make sure to go back and update those beneficiaries, because say if you list your current spouse and then you get divorced, there's not the same protection of the legal process to say, hey, you know what, he probably didn't actually want it to go to his ex-spouse after they got divorced. It will go to the person that you list. So just be aware of that and make sure they're up to date frequently. And yeah, again, generally you can do this online. With banks, maybe a little less so, but generally it's a super easy process. So a summary of what we've talked about today, as we are just near the end here. For budgeting and cash flow, understand and take control of your cash flows with budgeting and good debt usage as you move forward. For taxes, be aware of above the line deductions, below the line deductions, and credits that are available to you. For investments, I would say just maintain a long-term strategy, be consistent about saving, make sure you're well diversified, keeping things low cost, and making those contributions as early as possible. And that's usually a very winning strategy. For retirement planning, make sure to utilize your retirement accounts, especially employer accounts, and make sure to get that free money in the form of any match you might have. And then for estate planning, I'd encourage everyone to make sure they have a will, trust, a revocable trust if you have real estate, especially, and then make sure your beneficiary designations on accounts are up to date. Our next webinar will be on May 6th, and it is Understanding Your Employer-Sponsored Retirement Plan. So feel free to take a moment here to look at the registration link. Feel free to send me an email if you can't find the current registration link if you're viewing this after the fact. And thank you for attending.